A call option represents a bullish position. It is used when there is an expectation that the underlying stock will increase in price. The buyer of the call is positioning for upward movement, with the goal of the stock rising above the strike price and ultimately beyond the break-even point. For this illustration, all price movements in the underlying stock are assumed to occur within a single day. This isolates price action and removes the effects of time decay, meaning theta is not a factor in this example. We are also diminishing the effects of delta to concentrate on price movement. The focus is strictly on how changes in the underlying stock price impact the value of the call option. This example uses XYZ stock to introduce how a call option works using a simple profit and loss framework. The current stock price is $48. A long call option is selected with a strike price of $50 and a $2 premium is paid, which establishes a break-even level at $52. At the current price of $48, the position is still at a loss. The stock is below the $50 strike price, meaning the option has no intrinsic value, and the $2 premium paid remains unrecovered. For the trade to break even, the stock must rise to $52, which is the sum of the strike price, $50, and the premium paid, $2. Only above this level does the position begin to generate profit. At a stock price of $49, the position is still not profitable. Although the price has moved closer to the $50 strike, the option remains out of the money, meaning it still has no intrinsic value. The full $2 premium paid has not yet been recovered, resulting in a net loss of $2. This reinforces that simply approaching the strike price is not enough. The stock must exceed the break-even level of $52 before the trade begins to generate profit. At a stock price of $50, the option reaches its strike price and is considered at the money. At this level, the call option still has no intrinsic value, because the stock price is equal to the strike price, not above it. The $2 premium paid has not yet been recovered, so the position remains at a net loss of $2. This highlights that even when the stock reaches the strike price, the trade is not profitable. The stock must move beyond the strike and toward the break-even point of $52 to begin offsetting the initial cost. At a stock price of $51, the option is now in the money and begins to gain intrinsic value. The call option is worth $1 because the stock price is $1 above the $50 strike price. However, since the original premium paid was $2, the position is still at a net loss of $1. This shows that while the trade is moving in the right direction and starting to recover value, it has not yet reached profitability. The stock must still rise to the $52 break-even point to fully offset the initial cost. At a stock price of $52, the option reaches its break-even point. The call option now has $2 of intrinsic value, because the stock is $2 above the $50 strike price. This exactly offsets the $2 premium that was originally paid, bringing the position to neither a profit nor a loss. At this level, the trade has fully recovered its cost, and any additional increase in the stock price beyond $52 will result in net profit. At a stock price of $53 and beyond, the position becomes profitable. The call option now has $3 of intrinsic value, which exceeds the $2 premium paid, resulting in a net profit of $1. For every additional $1 increase in the stock price, the profit continues to grow accordingly. At this point, the option holder has the right to buy the underlying stock at the $50 strike price and could immediately sell it at the higher market price to realize the gain. However, in practice, most traders choose to simply sell the option itself to capture the profit rather than exercising it, as this is typically more efficient and avoids the need to transact in the underlying shares. This example illustrates how a call option transitions from loss to profit as the stock price moves higher, with the break-even point acting as the key threshold. It is important to note that this simplified scenario assumes all price movement occurs within a single day, intentionally excluding factors such as theta, time decay, and delta, price sensitivity. These elements play a significant role in real-world options pricing, but have been removed here to focus strictly on the relationship between stock price and option payoff.